Nilesh Shah joins us to talk about markets, stocks, where is he picking his spots, and how does he expect markets to move in next quarters, given that we don't know where the medical news is headed. Nilesh, fantastic to have you back, and thank you for joining us. Nilesh, let me just throw the headlines at you. The headline one is demand disruption because of medical news. Crude at $70. And C, companies are indicating that there is going to be a pull down in demand because what is happening on ground. If the headlines are not favorable, why are markets holding on?
Good morning, Nikunj, and good to be on ET now. Well, yes, the headlines surely are not the kind of headlines that we all will want to have, but there are a couple of things which are happening, which is essentially is that there is basically a surge in global prices of several commodities, and obviously, of course, India is a producer of some of these commodities, which obviously is going to basically breed inflation. But inflation, in a way, is positive or earnings accretive for several of the businesses which are here in India. So to that extent, yes, crude is at 70 and some of the other commodities obviously are at a multi-year high, but that's inflation and therefore that leads to earnings growth, number one. Number two is, in a way that unleashes the animal spirits of producers, which is basically, and therefore they are going to basically go on to a capex spree and they're going to increase capacity and things of that kind. And therefore you're going to see heightened economic activity. This sounds counterintuitive, but this is going to basically trigger some kind of a heightened economic activity, which again, I think bodes well. And the third, of course, is that, yes, currently we do have a challenge of the second wave of COVID, and it's definitely impacted, sentiments at the individual consumer level. And of course, a lot of discretionary spending is going to get postponed. But having said that, it's quite likely that maybe in a couple of quarters, by the end of this calendar year, or towards the end of this calendar year, you're going to see a significantly larger share of the population which will get vaccinated. And it will be business back to normal. So yes, this quarter is likely to be weak. Maybe the first half of this financial year may also be relatively tepid, but you're going to see demand come back in the second half of this financial year. And it looks like that the market is probably focused more on the scenario 2 quarters away rather than what it is currently. So that is one. And two is, of course, global liquidity is still there. And that's something which does matter in the very short term. So I believe that it's a combination of all of these things, which probably, yes, they look a little negative, but on the whole, they're incrementally positive. And that's basically getting reflected in the markets.
Are we in for a repeat of a same playbook like what we saw same time last year, which is when the reopening started, the demand surprised us, or this time it's going to be different?
Surprised if, the demand actually surprises us. And Nikunj, one area where it sounds little, again, counterintuitive, it sounds contrarian, but my view is that we are going to see a huge demand for real estate, residential real estate. And the reason for that is that, look, there is a consensus that we are getting into or we have stepped into an inflationary environment. And one of the best hedges against inflation is real estate. Property prices haven't moved for almost a decade now. And when there is basically fear, there is a tendency to flock to financial assets. And when there is basically a kind of a calm or a cheery consensus, money does shift into hard assets. And this has essentially been the conventional thought process here in India. Also, globally, real estate prices are on a tear. You look at the property prices in the United States or in Europe and all these places, real estate prices are going through the roof. And I wouldn't be surprised if something like this happens, though, of course, it may not kind of advance like that. But even a small increase in demand, even if it is investment-led demand in property prices in residential space, you will actually see a surge in demand there. And we know that if there is a bit of a surge or improvement in demand for homes and other spaces, it again, in a way, fuels demand for many other things. And therefore, I come back to the same thing that I actually believe that the demand environment is going to get better from here onwards. Maybe it's just a couple of quarters away, but I see that coming back.
Nilesh, it's a great point that commodity inflation is back and real estate is back, demand is back. My question to an equity investor is that if you're bullish on metals, why not buy metals in metal? Why not buy metal stocks or metal, not metal stocks, but why not buy metal in the futures market? And if you're bullish on real estate, why not buy a house? Why should one indirectly buy a stock of Tata Steel or a DLF because metal prices are strong or because real estate prices will move higher?
Yes, if you're generally bullish on metal prices, then of course there is no harm in going out there and buying these metal futures and things of that kind. But we have to keep in mind that basically historically the underlying equity gives you much better returns versus essentially the end product prices, which means that if iron ore prices go up by 20%, you see a iron ore producer or a steel stock go up disproportionately higher. So it's essentially a higher beta play. Owning the stock or owning the company is a higher beta play, and their ability, the delta from just a 10-20% spike in iron ore prices or metal prices brings about a much higher delta in terms of earnings, because that leaves the company, the producer, with a lot more cash flows. He uses those cash flows to basically do away with leverage, do away with debt, and therefore basically there's a huge amount of saving in financial costs, and therefore the growth in earnings is disproportionately higher. So I clearly believe that that owning metal producers, owning iron ore producers, and that entire pack is way better than just owning basically the futures and all of that. Second is coming back to property. You have to keep in mind the liquidity, that owning a real estate developer or owning a home developer or owning any other building material kind of a company is way more liquid than owning a house. It's way more liquid, it's more tax efficient. So these are some of the things which basically go in favor of owning a stock versus owning basically the underlying asset.
Nilesh, one spot of bother is autos. Demand has got destroyed and margins are under pressure. Yet auto stocks have done reasonably well. Why is that?
Again, it probably is more around the belief or the faith that demand will come back, that this is a temporary lull. It's fine if volumes are down 10 to 15% in April, May, and maybe for this quarter. But in general, the auto demand or the demand for vehicles should basically come back. And you will see this 10 or 15% dip in volume getting compensated by basically pent-up demand, which could basically come in. Number one. Number two is that while the rural economy or the rural areas seem to be now as impacted with the second wave of the COVID, but we have to keep in mind that there are forecasts of a very strong monsoon. And we have to also keep in mind that 70% of the population still lives in rural areas, and therefore, if you have a normal monsoon, if farm prices are again going up, which we are seeing, then this basically is going to lead to a huge boost in farm incomes and incomes for people living in rural areas, and that extra income or additional income is going to spill over into a lot of discretionary stuff like homes and automobiles or vehicles. So clearly what it looks like is that in the very short term, there has been an impact in terms of demand and volumes, but maybe 2 quarters away, my sense is that demand should normalize, and that should again kind of, augur well for the OEMs. The question, of course, is how do you play this entire auto demand? Do you play it by directly owning OEMs, or are you better off owning auto anchs? The auto ancillary companies, which apart from, of course, demand from OEMs, have a couple of more demand drivers, which is the replacement demand and the demand coming in from exports. So you have different ways to again play, but clearly believe that the demand is poised to kind of come back in the second half of the financial year.
Nilesh, a lot will now depend on the medical front. Fingers crossed, looks like the second wave is speaking out. But then what about the third wave? If it happens medically, we don't know. What I'm trying to perhaps understand from you, Nilesh, is that on the medical front, which is still a moving part, you cannot have assumptions, you'll have to go by the reality and accept the reality. What are markets pricing in?
Well, what it looks like and the way the markets have been very resilient in the very short term, what it looks like is that Nikunj, when we know of something coming, it's pretty much not like kind of it's a known unknown. Let me put it this way: the third wave is a known unknown, which means that we know it can come in. Unlike the second wave, where basically maybe all of us basically got caught off guard that about the second wave, or we underestimated the strength of the second wave or the quantum of the second wave. I think we all underestimated it. We knew yes, the second wave is round the corner, but would it kind of be of this proportion is something which we all underestimated. The third wave is a known unknown, and keep in mind that between the first wave and the second wave, we didn't have, in a way, a remedy, which is basically the vaccines. What is now going to happen between the second and the third wave is that hopefully a vast majority of the population, or vast majority of at least the urban population, is likely to be vaccinated, which is in the next 3 to 6 months. So the question is, when does the third wave come? A third wave, if it comes a month later, then obviously we have challenges of a different magnitude and a different proportion. But if it comes, let's say, with a gap of maybe 3 to 4 months, impact of the third wave is going to be a lot less. And hopefully, a lot of lessons would have been learned with the experiences of both the first wave and the second wave. So my sense is, if the third wave is still probably several months away, I believe that we as a nation, we as a society are going to be far more well prepared to deal and cope with the third wave versus where we have been with the second wave or the first wave.
Fair point. I want to break out a stock today which has done exceptionally well in last one month, I would say, Praj Industries. Now the whole idea is that ethanol blending moves forward. The whole blueprint of ethanol blending, which was supposed to be implemented by 2030, moves to 2025. Praj Industries, just for our viewers, is getting fantastic orders in terms of executing some of the ethanol blending machinery. They are, in a sense, a large market leader there. Nilesh, this is one of those stocks every old timer will recognize in the last bull market. But Praj Industry in last 1 month has been a phenomenal wealth creator. Do you track this one?
Yes, Nikunj, track it reasonably well. And obviously, of course, the extent of the price movement is a little surprising. And obviously, this is essentially happened with many other pockets of the market, especially for the ones which are connected to commodities. So obviously, Praj in a way is indirectly connected to the sugar cycle, because the sugar cycle is again connected to ethanol. So in a way, these are all pretty much webbed into each other. And so the surge in stock prices in sugar stocks and everything else is also basically kind of spilled over to a player like Praj. The beauty about Praj, of course, is that it's pretty much the winner takes it all. That in the sense that if the ethanol opportunity, which I believe is a real opportunity, and has massive support from policymakers, clearly Praj ends up being a disproportionate beneficiary of this. So to that extent, and that's got reflected in their most recent quarterly performance. But having said that, now Nikunj, with this kind of a price surge, I would be basically circumspect in terms of a disproportionate upside from the current levels. As a company, it will continue to do well. Clearly, the traction on the order front is fantastic. They continue to be leaders, and they remain a winner. But clearly now at this kind of a current stock price, I don't expect it to kind of now deliver massive returns the way we have seen the kind of returns unfold in the last 1 month or 2 months, or maybe even in the last 1 year. So one has to be careful with that and moderate expectations. I believe that a lot of the strength in the near-term performance is pretty much reflected in the current stock price.
Last time when we spoke about Cipla. We spoke about why are you bullish on mid-cap IT. which is LTTIS. Haven't discussed stocks after that. What have you acquired after that?
Okay, so we basically looking at basically again. I mean, of course, the whole space continues to look attractive, and we continue to like the pharma names which you mentioned. We continue to like the mid cap IT space. But again, I said is that I come back to the pocket which I like quite significantly is essentially the pocket around home development and building materials. That's a space which we are incredibly optimistic about. So that's one space. Two is that we continue to be very positive on the market direction and the participation from retail investors. So basically, online brokerage is a space that we like quite a lot, and so that space has been one of our most recent additions.
There are lots of online brokerage companies, Nilesh. There is ICICI Securities, there is Angel. Sorry?
The publicly listed, yes. Of course, there are several of the online brokerages, but the publicly listed which went IPO most recently.
Why do you like that business? It's a brutally competitive business. Zerodha, in a sense, is the Reliance Jio of online brokerage, and we know that when there is a disruptor who has technology and ability, it's going to whipsaw margins and the profitability.
Well, the option to own Zerodha is not there for us. So clearly, but we like this space. Clearly, if you look at it, Nikunj, in a country of 1.4 billion people, there are probably about 40 to 50 lakh demat accounts, and maybe even less than half of that essentially are active, so to say. And you're going to basically see that. So there's a huge gap. I mean, if I were to look at, forget what's happening in the United States and all of that, but some of our neighboring countries, some of our Asian peers, the penetration levels in terms of individual investors is significantly higher versus what it is currently in India. And I clearly believe that with the way where interest rates are low, there are limited other investment opportunities. I see a lot of the younger generation and people again from the tier 2, tier 3 cities and towns of India to basically come in and start basically investing directly on their own. And so to that extent, I clearly believe that the space is very exciting and the space is poised for very strong growth over the long term. And so therefore within that, if you can't own the leader, you might as well own the challenger.
Fair point. What is now in store from commodity stocks? Steel, sugar, non-ferrous. Can these stocks now still give double-digit returns in the next 6 months, or they have peaked out?
It's hard for me to say whether they have peaked out or not, because currently, of course, the price, in terms of the price of these end commodities, continues to be very, very strong. Global strategists are talking about, a massive capex cycle unfolding globally, which will further demand, which will drive demand for commodities, and therefore that could push prices higher. So I would be very careful before saying that the stock prices have peaked out or not. It's quite possible that they're ripe for some kind of a breather or a ripe for a correction. The kind of massive surge that we've seen in stock prices over the last 1 month or 1 quarter or 1 year, my sense is that there's a lot of momentum, there is a lot of euphoria, but I'd stop short of saying that whether there is froth or not. I believe that yet this segment has some more way to go. But having said that, given the kind of strong price momentum which has been there, I wouldn't be surprised if there would be a correction in the stock prices, or at least a breather, if not a correction.
Suddenly, nobody is talking about the manufacturing binge which was unleashed same time last year. PLI, anti-China rhetoric, China one policy. I don't see markets are focusing on that. Is that my observation, or you think that is genuinely happening?
No, you are right, Nikunj. But we have to look at this that, Nikunj, this is clearly turning out to be a very broad-based rally. And a rally which basically you're seeing a lot of rotation in the leadership. So if you pretty much look at it, every month or every quarter, you see basically a rotation of the sectoral leadership. So you have, you have IT. Suddenly, when dollar is raising its head, IT stocks move up. Then suddenly we hear about COVID, and then pharma stocks go up. Then suddenly we talk about some spike in iron ore prices, or China putting some additional, disincentives for producing and exporting steel. You find steel stocks going up. So this rotation, the market is indulging in sectoral rotation, and I don't think the manufacturing story, especially in pockets like pharmaceuticals, agrochemicals, specialty chemicals, auto components, auto ancillaries, I clearly believe that these are some of the sectors where there's a very strong tailwind of demand. Outsourcing is the buzz driven by Easternization and a China plus strategy. And clearly, India is at the center of all of this, where some of our companies have phenomenal cost competitiveness, which helps them to kind of become a very, very key and a pivotal part of the global supply chain. So my sense is that, yes, again, maybe these stocks or these sectors are taking a bit of a breather. But I wouldn't be surprised if, again, a month or 2 months later or down the line, they kind of come back with a vengeance. And this I see is basically happening with several sectors in the market, which again is because there is strong liquidity, there is strong earnings growth, and this is a broad-based rally.
Final question, Nilesh. How different is this market from 2017 and 18? That's the time we saw euphoric move in mid and small cap stocks. And then the end game was not great. The price action is quite reminiscent of the price action what we saw that time.
The only difference, Nikunj, I would say, is that in 17-18, I saw a lot of poor quality stocks, companies which were even pretty much almost bankrupt. Their stock prices, or where the management quality was really very bad. Even I found those kind of stocks would basically, rise and rally, and they actually gave you even more returns. And that was because there were a pack of investors who probably believed that because of reforms like demonetization, GST, bankruptcy code, all of these kind of things, these companies were basically sound and solvent, and that these economic reforms would help them to basically stop doing all the negative things that they were doing, and would align themselves with minority shareholders, and there would be a huge transformation in terms of the governance standards. So that was the premise because of which a lot of poor quality stocks did extremely well. What I see this time around is that yes, mid and small caps are doing well, but I still believe that the big shift between then and now is that I still believe that quality is foremost in the minds of investors and traders. And that to me is an extremely healthy sign. That doesn't mean that we cannot still have, bubbles and all of that, but, bubbles need not be just around quality. Bubbles can also be around valuations. So I find the big difference between 2017, 18 and now is basically that the investors and the traders are way more cognizant about the quality of the underlying companies that they are trading or investing in.
All right, Nilesh, thank you so much for joining us this morning. Great having you with us and speaking to us here on ET Now.